Hello, before we start today's video, just a quick note that if you are interested in purchasing this indicator, just simply email us at daytradinggps@gmail.com to request a discount promo code. In return for you taking your time for watching this video today, you can email us and request a discount promo code that will give you a substantial discount on the purchase of the indicator. All of our indicators are sold on a one payment for lifetime access basis. Thank you. One more thing before we get started, you'll see in the description of the video, there will be this section here, which is click on this link for descriptions links to the other videos mentioned in this preview on different topics about the SPX indicator. So this is a Google Drive link. I'll show you where it takes you to now. So when you click on that link for the Google Drive, this is where it takes you to, which as you'll see is a list of different topics and links to the videos on the specific topics. These topics go into more detail. We may reference some of these topics very briefly in today's video, but when we reference to go look at the video that provides more details, then you'll just simply click on this link and go to here, and then you'll be able to click on the link that you want to see a more detailed video on a certain topic. Thank you. Hello, in today's video we'll be taking a look at the Wednesday, November 5th, 2025 trading session for the CBOE SPX index. We'll be utilizing the day trading GPS SPX Daily Key Levels indicator for SPX call and put option trades. Specifically, we'll be using the newest version of this indicator, which was just released a few weeks ago, the V2.0 version of this indicator. Okay, so some of you may be already familiar with how this indicator works, but for those who are new to this channel, who have never seen any of our videos on this indicator, I will run through how the indicator works before we get into today's session. This indicator is for the TradingView platform only, and it works on two different SPX symbols on the TradingView platform. So the main symbol that it works on is the SPX symbol, and on TradingView you would simply under symbol search type in SPX and then look for SPX under the CBOE exchange. So that is the symbol we have it on now, and that is the main SPX index that everyone follows. The second symbol that it works on is the SPX 500 8-cap symbol, which is a Forex CFD. Here is a chart of that symbol. SPX 500 is what you would type into your TradingView symbol search, and then you would look for the SPX 500 symbol under the 8-cap exchange. This is a Forex CFD that does trade in the overnight and pre-market session. There's a couple of reasons why this indicator also works on this particular symbol. One of which is to accommodate traders who trade Forex only and do not trade SPX index options. Also, for those traders that are involved in trading challenges with Forex-based companies such as FTMO, Apex, the 5%ers, and there's many dozens more of them, that allow traders to take a trading challenge in which they need to make a certain amount of profit in a certain amount of trading days while not exceeding a daily loss limit or a total loss limit. And typically those types of companies are Forex based and allow you to trade Forex currency pairs such as Euro USD, USD JPY, and then for indexes and metals, they allow you to trade CFDs. So in the case of SPX, it would be SPX CFD instead of trading SPX index options. So for those traders trying to pass a trading challenge with one of those companies, you can use this indicator for that purpose on the SPX 500 8-cap. There is one reason why if you do trade SPX index options, why you would want to have a second chart open up on TradingView and have it on the SPX 500 8-cap symbol, and that is because you can get the levels for CBOE SPX index 30 minutes prior to the 9:30 a.m. Eastern New York open for SPX index. The SPX CBOE index does not trade in the overnight or in the pre-market, and it opens at 9:30 a.m. Eastern New York time. Because of that, the way TradingView PineScript coding limitations work is that even if your indicator is plotting levels for each session, if it already knows the levels prior to the market open, in this case 9 a.m., 30 minutes prior to the market open, it is not able to, because of PineScript limitations, display those levels on the CBOE SPX chart until the first tick of the 9:30 a.m. New York open. So by having a second chart open on the SPX 500 8-cap symbol, that allows you via the second table here to see what the CBOE SPX daily key levels are going to be for today's session and get them at 9 a.m. Eastern, 30 minutes before the open. This gives you time to do your own analysis and do some planning depending on what kind of strategies that you'll be employing, looking to employ for the session. This other table here is specifically for the symbol that it's on, the SPX 500 8-cap. So these are the key levels if you're trading the Forex CFD, and then these are the levels on the chart that match the ones on the table here for SPX 500. The table here, the additional table, will be the same levels that you'll see on your CBOE SPX chart at the 9:30 a.m. open. Okay, so we're back on the CBOE SPX chart. All right, so you can see we're on a 2-minute chart time frame. That is the recommended chart time frame to use for the core strategy for the daily key levels indicator. The range of chart time frames that are recommended are from 1 minute up to 5-minute chart time frames for this strategy, with the recommended chart time frame within that range being the 2-minute chart time frame that you will see on all of our videos. Some people prefer to trade other chart time frames such as the 1 minute, 3 minute, or 5 minute, and it could be because they're also using other indicators that they like in conjunction with this indicator, and that's fine as well. Just know that the ideal time frame for this particular strategy is going to be the 2-minute chart time frame, but you can use it effectively in a range from 1 minute up to 5 minute. Now there are people that use this indicator for other strategies besides the core strategy that we present in all of our videos, that is the core daily key levels strategy. So some of those people employing other strategies such as iron condors or butterflies or other types of combination trades may find it useful to work on chart time frames of 10 minutes to 30 minutes as opposed to the 1 minute to 5 minute chart time frame. But everyone's different. Everyone has a different preference for chart time frame. The limit on the chart time frame with this indicator is 30-minute chart time frame. So this indicator cannot be used on longer than a 30-minute chart time frame, primarily because of the limitations on PineScript with the various algorithms that this indicator uses. Okay, so the way this indicator works is that at 9:30 a.m. Eastern New York time, you will get the daily updated key levels on your CBOE SPX chart. Now, the main key levels are going to be your bull bear key price level, the R1 through R6 main levels, and the S1 through S6 main levels. So the bull bear key price level is the most important level for the session and is considered a main level, and then also the R levels and S levels are considered main levels as well. So with this indicator, you can take bullish and bearish trades off of the bull bear key price level, as well as any of the main R levels, R1 through 6, and main S levels, S1 through S6. As we mentioned in the preview to this video, there is a link in the description of this video that has a link to other videos, and one of those videos on one of the other topics concerning this indicator is a video that goes into detail about taking trades off of the other main R1 through R6 levels and S1 through S6 levels, and it also goes into discussing the two different types of trade entries. So regardless of whether it's a bullish entry or bearish entry, there are two different types of trade entries with this indicator. One is the standard trade entry, and the other is the more conservative trade entry, which requires additional confirmations. And that video also goes into discussion and shows you examples of standard entries versus more conservative entries with the additional confirmations, and explains those, and also gives several examples of those. Okay, so the main look that you will have on the startup of the indicator is that you will have the default levels of the bull bear KPL, the R1 through R6, and S1 through S6. However, when you are first starting the session, you'll want to drill down and maximize your screen on TradingView by taking your cursor and to the right price axis and maximizing it out of the R6 down to S6, which is too compressed of a look at the beginning and will look too busy, and you want to expand it out to have a look of either R3 through S3 or R2 through S2, or some combination thereof between those ranges, such as you see here on the screen. That way that you can drill down and see the important other levels that are surrounding the bull bear key price level, which will come into play, and we'll explain those as we go into the trades here, what their relevance are. So on the startup, you will have those levels, and then you will also have a certain number of midpoint levels and QL levels that are displayed. Right now we've turned on some of the other midpoint levels that are normally not turned on, and you can turn those on and enable them in the user control panel. The midpoint levels that are turned on by default at startup are the mid BBKPL R1, which is the first midpoint above the bull bear KPL, and the mid BBKPL S1, which is the first midpoint below the bull bear key price level. Also, these two QL levels, the QL above the BBKPL and the QL below the BBKPL, are also turned on by default. The other midpoint levels that you see here were turned on manually and enabled by us after the session started, mainly because of the direction of the trading that was occurring as the session progressed. Also, you'll see this table here, which is the SPX PMH, which stands for pre-market high, the SPX PML, which is the pre-market low, the YDH, which is yesterday's daily high, which is the previous session's RTH session high, the SPX YDL, which is yesterday's low, which is specifically the previous day's RTH session low, and then SPX YDC, which is specifically the previous day's RTH session close. These levels are also very important in the context of the overall session, and also can be important if they are in confluence with other other main key levels. One thing to keep in mind is that on any given session, if we're going to see significant upside in a particular session, the price is not only going to have to start closing above the bull bear key price level, but it's also going to have to close above the PMH level and stay above the PMH level to start reaching the other levels. So breakouts occurring under the PMH, or is PMH containing price and sending price back down? The same thing with the pre-market low. If we're going to see a significant sell-off session, then not only is price going to have to fall below the bull bear key price level and close below it, but it's also generally going to have to start closing below the pre-market low as well. Or is the pre-market low acting as support in a session and containing price? Also, the same can be said for yesterday's daily high, the YDH, yesterday's daily close, and yesterday's daily low. As we saw in today's session, yesterday's daily close and yesterday's daily open were both slightly under the bull bear key price level. So these prices can also act as magnets for price, and can also, in the general context of the session, that price, not only to have a sell-off, is going to have to close below the bull bear key price level, but also, because of the positioning of these levels, is going to have to start closing and staying below both of these levels, with the next important level other than the key levels being this PML level. Also, these levels, depending on where they are located and depending on which levels that you've taken your trades from, they can also act as waypoints for decision making once your trade has reached a favorable level move of a certain amount or more on regular trades. Regular trades require a certain minimum level move in order to reach their target, and then once they've reached their target, then if any of these levels are above that target on a bullish play, after it's already exceeded the minimum required move for a regular trade, they can also act as decision points for either exits or for adjusting stop losses, as they are important levels that oftentimes will either see a reversal or stall at those levels, or can see a major breakout occurring from those levels. Okay, one thing to keep in mind is that these tables that you see here are optional to be enabled and left on the screen. You can move them to different parts of the chart. They are independently controlled both by size, so you can control the size of this one by itself, and you can also move it to different parts of the chart. And you can control the size of this one, move it independently to a different position on the chart, and you can also turn either one of them off or both off, or leave them both on as we have here. Also, the groups of line labels are also individually controlled. So a group of a line label would be the main key levels, which is the bull bear KPL, the R1 through R6 and S1 through S6. Those are individually controlled line labels, and you can individually control the size of that group of line labels, as well as the offset to the left or right. Same thing for the midpoint levels. All the midpoint levels are controlled as a group as far as the line labels, so you can make them smaller or larger, and you can also control the offset as a group for those as well. And the same thing for the QL levels. They are controlled as a group. The YDC, YDL, and YDH are also controlled as a group, and the PMH and PML are also controlled as a group. So you can customize the look by positioning the labels. Here I have all of the main levels, the mid levels, and the QL levels all on the same offset. However, for me, I prefer the main levels to be a larger font and larger type, and then have the midpoints at a normal size, and then the QL levels at a smaller size. But if you prefer a different look, you can individually control these and customize it to whatever look that you feel is best for you. And the same thing with the other levels here. These are currently shown in the normal size. Okay, so we have the 9:30 opening candle marked off here. As you can see, it opened below. It tried to travel up to the bull bear key price level, but closed below the bull bear key price level. And it closed within a certain zone from the bull bear key price level to S1. This is your bearish entry signal for this particular trade if you're going to take the 9:30 a.m. opening trade. As we've said on many of our videos, the 9:30 a.m. opening trade, we do have rules for that trade, and there are times where you would not take a 9:30 a.m. opening trade if you were inclined to take the trade normally, because it is out of range, meaning it is gapped and closed so far below or so far above the bull bear key price level that it is not effective, or from a risk reward standpoint, it does not make sense to take either a bullish or bearish trade. And we do have a video on trades to avoid on the 9:30 a.m. opening candle. That is also found in that link that you can click on to the other videos that's in the description that we went over in the preview. There's also a document, a PDF document, that there is a Google Drive link to that's also found on that link page, where you have the descriptions of the videos. That goes along as a companion to that video, which explains in more detail along with following that particular video. So I would invite you to look at that video as well. Those sorts of exceptions to the 9:30 a.m. candle trade happen perhaps 5, 6, 7, 8 times a year at the most. However, with this indicator, there is no rule or obligation in the core strategy that you have to take the 9:30 a.m. candle if it is within the zone of either a bullish or bearish trade. You can simply wait for price action to play out and then pick and choose which levels at which time that you prefer to take either your bullish or bearish trades on, whether it is from the bull bear key price level or whether it is from one of the main R levels or main S levels. So I just want to make that clear that with this core strategy that you do not have to take the 9:30 a.m. candle. You'll see on our videos that we do take it as part of our implementation of the strategy. However, there is no rule or obligation on the strategy that you must take the 9:30 a.m. candle trade. So for those of you who like for price action to play out and for the opening range to play out of, say, either the first 5 minutes, 15 minutes, 30 minutes, or 1 hour, or what have you, that is fine. Because with this indicator, you're looking for precise entries when it is suitable for you to take that trade. Meaning that you do not have to take the opening trade. you can simply wait for price action to dictate and come to the zone that you prefer to take your trade on and the level that you prefer to take your bullish or bearish trade on. Just keep in mind that with this indicator, the levels that you take your trades on are the bull bear key price level and any of the main R and S levels, meaning the R1 through R6 and S1 through S6. The midpoint levels and the QL levels have different purposes. The midpoint levels are used for standard stop losses depending on whether it is a bullish or bearish trade and depending on which level that you're taking the trade from. For example, a bearish trade taken from the bull bear key price level, the standard stop loss is the midpoint above the bull bear KPL, whereas a bullish trade taken from the bull bear KPL level, the midpoint below is the standard stop loss to use for that bullish trade. If, for example, you were taking a bullish trade off of the R1 level instead, then your standard stop loss level is the midpoint level below the R1 level on that bullish trade taken from R1. On a bearish trade taken from R1, your standard stop loss is the first midpoint level above R1. And the same thing would go for R2 or for the S levels down here. If you took a bullish trade off of S1, now we don't have the midpoint enabled here between S1 and S2, but if you took a bullish trade off of S1 looking for price to return back to the bull bear key price level or above, then your standard stop loss on the bullish trade taken from S1 is the first midpoint below mid S1, S2. Whereas a bearish trade taken off of S1 looking for price to continue down would be the midpoint above S1. The QL levels are your tight stop losses above and below each level. Right now we only have the tight stop losses turned on above and below the bull bear key price level. However, in the user control panel, you can turn on the QL levels above and below any of the main levels. Typically, it's best to use the standard stop loss, which would be your midpoint levels for any trades. However, there are many people who prefer the tight stop losses, even though they're going to be more prone to getting stopped out because they prefer not to have as much money at risk. So if you're going to use the tight stop losses, then as an example, on a bearish trade on the bull bear KPL, your tight stop loss in a bearish trade taken from that level is the QL above. Whereas on a bullish trade, your tight stop loss is the QL below. If you were taking a bullish trade from R1 and wanted to use a tight stop loss, then you would enable the QL below R1, and that is your tight stop loss. If you were taking a bearish trade off of R1, looking for price to go down, then your tight stop loss, if you prefer to use that, would be the QL above R1. And the same thing for each of the other levels as well. A bullish trade off of S1, if you wanted to use a tight stop loss, would be the QL below S1, so you would simply enable that level in the user control panel. Okay, so getting back to this first trade here, if trading the 9:30 a.m. opening candle, this is a bearish entry. Now, what about option strike selection? On any trade off of any main level, there are always going to be 3 strikes to consider. One is the at the money strike that is closest in price to the level that you're trading from. In the case of the bull bear key price level for today's session, the price is 67.7452. So the closest SPX strike to that is 67.75. If it's a bullish trade, then it's a 67.75 call, and if it's a bearish trade, it's a 67.75 put. The at-the-money 67.75 is considered the standard play in this strategy. However, you do have two out-of-the-money strikes that you can always consider on any bullish or bearish trade taken off of any level. So for example, just to clarify, if we were taking a bullish trade off of S1, since S1 is 67.5741, the closest strike to S1 is 67.55. So on a standard play, at the money strike on a bullish play off of this level, then you would select the 67.55 call. If instead you were taking a bullish play off of R1, it's 67.9163. In the case of that, your standard at the money play would be the closest strike to this, since this is the level you're taking the bullish trade from, and that would be the 67.90 call. For the out of the money strikes, it's pretty simple. You look in the direction that you're trading, and you look at the first midpoint above if it's a bullish trade, or the first midpoint below if it's a bearish trade. So as an example, on this particular bearish trade here on the opening candle, our first out of the money strike we can consider, we look down and we have mid BBKPLS1, which is 67.65 excuse me, 67.6597. So the closest strike to that is 67.65. So if you preferred to use an out of the money strike as opposed to the at the money because of the cost of the at the money, then you would instead use a 67.65 put. What is the furthest strike that we can consider using on a bearish trade from this level? Well, we look in the direction that we're trading, which on a bearish play down, and that would be one level away. So your first out of the money you can consider is a half level in a direction, and the furthest out of the money strike you can consider is the strike closest to the one full level away. And in this case, that's the 67.5741 S1. So that would be the closest strike to that, which is the 67.55 put option. It works the same way on other levels. So as an example, if we were taking a bullish trade from R1, we would look up. The at the money would be the 67.90 call. The first midpoint above is 6,819. So 6,800 call would be our first out of the money option we can consider. And the furthest out of the money option we could consider would be the R2, closest to the R2 level, 6808.75. So that would be the 6810 call. If instead we were taking a bearish play off of R1, again 67.90 put, because that's the closest, that's the standard at the money, then we would look down. First out of the money would be closest to this level here. This is slightly over the midpoint between 67.80 and 67.85. So the closest strike would be the 67.85 put. Whereas one level away from R1 on a bearish play is the bull bear KPL. So then the furthest out of the money strike you consider for a bearish play off of R1 would be the 67.75 put. Okay, so getting back to this trade here, If you were inclined to take the 9:30 opening candle trade, then this is a bearish trade because it closed below the bull bear key price level. It would not matter if it opened above. We're more concerned about where this candle is closing. So this candle opened below, never crossed above, and closed below. If it opened above but yet closed below, that's still a bearish play if you're taking the 9:30 a.m. opening trade. If instead this had closed above the bull bear KPL, then this 9:30 a.m. opening candle trade would instead have been a bullish play. It would not matter that it opened below. What matters is where it closed, and if it closed above. It could have opened above, stayed above, or even crossed below after opening above. The main point is, where is it closing? So you were waiting until the candle closed to also buy whichever strike that you're going to use if you're going to enter into this 9:30 a.m. Candle trade. All right, so on this one, the at the money, as we said, is the 67.75 put. On the 9:30 a.m. 2-minute candle close, it's $20.68. That's going to be $2,068 for one put. You get that by multiplying the price you're paying times 100, and that is the cost of one put option. If instead it was $15, then you'd be paying $1,500 for one put. Your standard stop loss, as we mentioned earlier, this is a bearish play from this level, so your standard stop loss is this midpoint level here, whereas your tight stop loss is this level here. With this indicator, your initial stop loss is always going to be level based, not price based, not the price of the option based, but level based. So you're stopped out if SPX hits your tight stop loss level or your standard stop loss level. There are brokers that offer stop losses based on the price of the underlying. Every broker offers stop losses for options based on the price of the option. If you bought this option for $20.68 and you wanted to make your stop $15, every broker will do that. However, there's only a few brokers that allow you to have the additional feature of being able to place conditional orders or stops that are based on the price of the underlying, whether we're trading SPX or you could be trading Tesla stock or you could be trading whatever. And only certain brokers will have a feature that allows stop losses and take profits based on the price of the underlying. The two brokers that I know of, one is Interactive Brokers and the other is Thinkorswim. The Thinkorswim platform, in my opinion, is a lot easier to use than Interactive Brokers. However, many people swear by Interactive Brokers and love their platform. I think it's a little too hard to use myself, but for those people that have gotten used to it, I guess what I'm trying to say is it takes a lot longer to get used to it than Thinkorswim because it's not as intuitive, in my opinion, but it is incredibly feature rich, Interactive Brokers, and it is one of the few brokers that does also incorporate that feature. So in the videos and the link that we had in the description, if you click on that link, which will take you to all the different videos on other topics, there are some videos there on utilizing the stop loss based on a price of the underlying, which would automate your stop loss. If you're not going to use something like that, then you're just going to have to watch and see if price touches. You can either set an alert for when price touches or crosses the stop loss level, if you can do it that way, or you can simply watch and manually stop yourself out. But it needs to be on the initial stop loss level based as opposed to price based. However, if you're doing a regular trade, as we will see here in a second, and if you've watched some of our other videos where we go into stop loss adjustments, once the trade is moved in your favor on a regular trade and hit the minimum target, then you have the option, if you're not going to close out all of your contracts, to adjust your stop loss. Then at that time, you are no longer using a level for your stop loss. At that time, you're just going back to the standard price-based stop loss, price of the option, and then you're moving once it hits that minimum target, if you are going to adjust your stop loss and not just close everything out. Then you're adjusting your stop loss to break even, which is the price you paid, or break even plus a profit buffer, which would just be adding a certain amount to the price that you paid. So once your trade goes in the money and hits the minimum required target for a regular trade, or any of the additional targets, and you're not closing out your trade and wish to adjust your stop loss on your contracts or the remaining runners that you'd have if you're scaling out of multiple contracts, then you are instead then using a stop loss that is price based, price of the option base. Okay, so we went over the out of the money put option strikes that you could also utilize. One which was the first midpoint below 67.65 and then the 67.55. The cost of the 67.65 on this candle close 16.20. The cost of the furthest out of the money 67.55 was $12.60. Now if you took the first 9:30 a.m. opening candle trade, that trade is a loss. That trade is a loss because, as you can see here, price failed to break through and stay below the YDL level. So it stayed contained within YDC and YDL. That's not specifically why you got stopped out, but price is not going below here. It did have this small dip here, then basically jumped back up. But as you can see here, it didn't close below, had a dip below, kind of a fake out, and then took off to the upside here. Where you're getting stopped out at is on your tight stop loss, the QL above. You're getting stopped out on this candle here, which this is the the 946 candle. It's this big candle here. You're getting stopped out of the tight stop loss, and then the 948 candle, you're getting stopped out of the standard stop loss. So no matter which strike you took here, also one thing I want to clarify is that if you're using out of the money strikes, it's still the same stop loss as the at the money. So it doesn't matter what strike that you're using out of that, the stop loss, the level-based initial entry stop losses are still the same, whether you're choosing to use a standard or the tight. So you're stopped out here. If you're stopped out of the tight stop loss on the at the money, you have a $668 loss. Now that's based on the low of the candle. That doesn't mean the low of this candle. What that means is the low price of the option, the worst case price that occurred during the candle at which SPX hit the stop loss level. So this is the worst case scenario loss occurring within that candle. It's possible that you could have gotten stopped out at a better price than this and had less of a loss, this is the worst case scenario. So on the tight stop loss, on the at the money 668 loss, on the standard stop loss, you had a $758 loss. On the first out of the money strike, on the stop out of the tight stop loss, 550 loss. On the standard stop loss, 620 loss. On the furthest out of the money option, the tight stop loss, you had a $460 loss, and the standard stop loss, a $500 loss. Now, there's two different scenarios here. As I talked about, there is no rule or obligation within the strategy that you have to take the 9:30 a.m. opening candle trade. We have to explain the 9:30 open candle trade because that is part of the strategy. That if the 9:30 candle, and this 9:30 candle is sort of a candle on its own. After this candle, so this is the only candle of the strategy where it's just a one candle strategy, meaning that where this closes determines the bullish or bearish play based on the bull bear key price level. And so if this candle was out of range and was a void on taking in one of those 5, 6, 7 times a year, if it's out of range, then you're not taking that trade, even if it's closing above or closing below on the 9:30 a.m. opening candle. That only happens a few times a year, as I stated, maybe 5 to 8 times a year out of the 250 or 252 sessions a year. However, it is important to know when you should avoid them if you're normally inclined to take the trade. So you don't have to take that trade, as we stated. Many people like to get the initial shakeout over with. As I said, a lot of people, whether they don't like to trade the first 10 minutes or 15 minutes, or some people define it as an opening range, which could be the first 5-minute opening range, the first 15-minute opening range, the first 30-minute opening range, or the longest opening range that most people will use is an hourly. So that would be the first hour from 9:30 to 10:30. And then decide, based on what price action is showing you, whether you're going to take a bullish or bearish trade off of where price is at as far as relationship to the main levels that it's trading at that time. So if you did not take this trade, then your first trade opportunity would be this candle here. This is the 9:46 a.m. candle, because we have a break up, close, cross above, close above the bull bear KPL, and it's still within range of the bull bear KPL. It's not exceeded that. If, for example, this candle had gone all the way up to R1 and closed here, then you would not be taking a trade off of the bull bear key price level. You would instead, if you were going to consider taking that trade, would be taking a trade off of the R1 level instead, and then you'd be looking at this strike instead, and then you would be looking at the out of the money strikes based on a bullish play from this level. So that's what we're talking about as far as being within range. So look at that video that is in that description, which talks about the candles to avoid on the bull bear KPL, and you'll get a better idea of what I'm talking about with that, along with the accompanying PDF document that goes into more detail. So we're not going to get into too much of that in this particular video, but I just wanted to clarify that for this, that it is within range. So this would be your first trade opportunity. Now, that doesn't even mean that you need to take this trade. So if you're more inclined to wait for the first 30 minutes to play out or the first hour to play out, then you can take a look at what trades to take at that time. But if you did not take the 9:30 a.m. candle trade, this is your first trade opportunity here. So this would be a bullish trade. The at the money is the same, 67.75. However, in this case, it's going to be a call option. Then our stop losses are going to be tight stop loss QL below or standard stop loss midpoint below. Now, before we go further, what if you did take this trade and you did have the loss? Well, if you used your tight stop loss, then you could still enter on this candle here for a bullish entry because you were stopped out here. If you used the standard stop loss, you were stopped out here on this candle, and this candle is still within the acceptable range for the bull bear key price level as far as a trade from the bull bear key price level. It's just about if it was closer to here, like say like this candle here, the next candle, and then up obviously this one here, which goes above R1, that is too much risk, mainly because you have to look at it like this. Your stop losses are going to be down here. So if price is up here, this is too much of risk with a stop loss versus the reward of where your targets are going to be on a trade from the bull bear key price level. So if you missed all this, if you miss these, then you're just better off waiting to take a trade off of R1. So if you got stopped out here, then you could have entered here. If you got stopped out on the tight stop loss, if you got stopped out on the standard stop loss, then you could have still entered here, although this candle is approaching the outer limits of the range, but it's still within range here. Okay, so to clarify, if you took this trade, you had a loss no matter which strike you did, and no matter whether you had the tight stop loss or the standard stop loss. You then could have entered into this trade here from the bull bear KPL after taking this loss if you were so inclined, because this is an entry signal for a bullish entry signal for the bull bear KPL. If you did not take this opening trade, then this candle, the 946 candle, would be your first trade. Alright, so now we're going to look at those two different scenarios. First, we'll look at if you did not take the 9:30 a.m. opening candle trade. So at this point, you don't have a loss. You have not placed a trade. And your first bullish entry is on this 9:46 a.m. candle, 67.75 call. The price on the 9:46 a.m. candle close is $20.10. Your stop losses on this bullish trade, tight stop loss here, or the standard stop loss here. As you can see, neither one of these stop losses came close to being breached. Your first out of the money option is the strike closest to this first midpoint above, 67.8308. That's a 67.85 call. Your furthest out of the money is the strike closest to the one level above, 67.91, so that's a 67.90 call. So your 67.85 call option was $14.50. So as you can see here, if you use that, then instead of paying $20.10, you're paying $14.50. So here you pay $2,010 for one option. Here you pay $1,450 for one option. Or if you use the furthest out of the money, $67.90, then it's $12. You're paying $1,200 for that option. And you're still using the same stop losses regardless of which one you use. Now, if you instead took this 9:30 opening candle trade, you use the standard stop loss, which is the one that we recommend that you use, and you got stopped out here, then your price on re-entering is going to be $20.80. Now, you're still using the same stop loss, and then in each one of these, as we're hitting targets up here, you'll see that we have outlined. Here is going to be, the first line is going to be if you just had this as your first trade. This line is going to be if you were stopped out on the first bearish trade and then entered from that loss into the new trade at 9 off of the 9 close of the 948 candle. So there's a difference in profit because there's a difference in price between what you were paying for this at the money here versus here. So I just want to make that clear before we look through these, so you know why there's a difference in price and why this one says one time and why this one says another time. And then we'll also have the two out of the money options that you could have considered as well. Now the out of the money ones are based on this scenario down here, just to clarify. The only one we're looking at if you were stopped out and re-entered is going to be the at the money. Okay, so what about target exits? Well, target exits depend on, with this indicator and this strategy, there's two different types of trades that you can take, scalps and regular trades. There's a difference between a scalp and a regular trade. First difference is a scalp only requires a one level move for the exit. Also with scalps, there's no stop loss adjustment. It's 100% closeout. It doesn't matter if you're trading one contract, 5 contracts, 10 contracts, 20 or more. On scalps, you're looking for a quick hit, one level move in your favor, and then you're out. Then if you want to place another trade, whether that's a scalp trade or a regular trade, it's just best to know before you enter a trade, generally speaking, you would like to know in advance in your mind, is this going to be a scalp trade or a regular trade? So it would be prudent for you when utilizing the strategy that, if you just want to scalp only, all your trades are scalps, that's fine. You want to make all your trades regular trades, that's fine. You want to decide on each one which one it's going to be and kind of mix it up, that's fine too. Just realize that on scalps, you're out after a one level move in your favor and you're closing out all the contracts. There's no stop loss adjustment. You're not staying in the trade. So on the scenario here, 2740 is the price. When it hits at 9:54 a.m., it hits the R1 here on this candle, and the price on this candle close is 2740. So that's a $730 profit. You paid $20.10 in this scenario here. The other one that you paid $20.80 for, you have a $660 profit. But remember, if you're re-entering after being stopped out with this 660, you're going to have an offset because you had a loss. So just keep that in mind when we're looking at these different scenarios. Whereas the top one, you did not have a loss, so this is just straight profit. because you did not enter the 9:30 a.m. opening candle trade. If instead you use the 67.85 out of the money call, then you have a $600 profit on the scalp when it hits R1. The 67.90 furthest out of the money call, 17.30 on the candle close, you have a $530 profit. Keep in mind that these are all per contract. So these are all shown in one contract increments as far as the profit and loss. So if you're normally the type of trader that's trading 2, 3, 4, 5, 10 contracts or 20, then you would just need to multiply these figures by that amount, whether it's a loss or a profit. Also keep in mind those do not include any commissions that you may be paying to your broker for getting into the trade and exiting the trade. Okay, so what about a regular trade? A regular trade requires a minimum 1.5 level move in your favor. So here, we were trading off the bull-bear key price level. We have a bullish trade. So a 1 level move in our favor is the first level above, main level above, R1. Whereas on a regular trade, we're looking for a 1.5 level move from the level we're trading. So that is going to be the first midpoint above R1, because that is a 1.5 level move. Mid R1, R2. You can see here on this candle here at 10:06, we have a high wick touch on this candle, and then it backed off. Of course, it did go back to it here and started closing above it here and closing right up against it. But here is the first touch. And on this high wick touch, the 67.75 at the money, for this scenario here, you have a $1,302 profit because it's $33.12 on this high wick touch. So if you are using the take profit exit based on the touch of a level, then that works to your advantage on high wick touches that back off. However, if you're going more with candle closes, as we saw here, can be more advantageous. There's really pros and cons of each. So here, I just want to clarify that these prices are shown on the high wick touch. However, if you're going to use candle closes, then since this backed off, these profits would be less than this, what is shown here, by probably a couple of dollars on the price. So you would take perhaps about $2 off of each one of these prices for the back off here if you're just getting out at the close. So really that's up for each trader to decide. Number one, if you're not trading with a broker like Thinkorswim or Interactive Brokers or another broker that offers that feature, then you're either just going to get out when you see a touch, or you're going to decide that you're going to get out on a candle close. And sometimes the candle close will work to your favor because it will close beyond the level that you're looking at, and sometimes it will back off of that level. Okay, so what else about a regular trade? Well, it's a 1.5 level move, but then you have on regular trade, the options are either 100% closeout, or, which means closing all of your contracts just like on a scalp, or adjusting your stop loss to break even, or break even plus an initial profit buffer of 10 to 15% added to break even. So that's what PB stands for, profit buffer. So either break even, that means now we're changing it to a price. So if we paid $20.10 for the at the money, then if we're just adjusting our stop loss to break even, then we're adjusting our stop loss to $20.10. If we're adjusting our stop loss to $20.10 plus a 10% profit buffer, you can just round it to $2. It doesn't need to be exactly to the penny, because when you're in the midst of trading, you want to be precise, but also be quick. So if you just think in your mind, $20.10 plus $2, that's $22.10. That's easy enough. We don't need to make it exactly 10% of 2010, which would be, $2 and a penny. It's best not to get caught up in that sort of minutia when you're doing the adjustment. You can either just round it off, or just to make it simple, so you're not having to fumble around and take too much time. Okay. The other thing is that if you don't want to adjust your stop loss, so either 100% closeout or adjust your stop loss on all of your contracts, so you're either closing out all of your contracts or adjusting your stop loss on all of your contracts, or if trading multiple contracts, then scale out, meaning closing out 70 to 90% of your contracts, and then adjust your stop loss on the remaining runners. So for example, if you had 5 contracts and you scaled out and closed out 4 of them, then you scaled out 80%, because 4 is 80% of 5. If you had 10 contracts and you sold 9 of them, then it would be scaling out 90%. If you're just trading one contract, then your choice is basically that you're either closing it out or adjusting the stop loss, because you're only trading one contract. So that's just up for each trader to decide for themselves. If you're satisfied with just the 1.5 level move and be done with it at that point, then you're only trading one contract to just close it out, or you can adjust your stop loss to break even, or break even plus the initial profit buffer. You don't want to add too much of a profit buffer on the initial trade, adjustment, because price typically has a tendency to go up. There'll be some profit taken, reload, go up again, reload. Same thing on the way down. Goes down, has a stair step, down, stair step, down. Rarely are you just going to see something that just keeps going down without taking a breath all day, or going up all day without taking any retraces at all. That does happen, but not very often. So if you add too much of a profit buffer on top of break even, then you run the risk of just getting stopped out, because and if you're going to do that, if you're more inclined to, well, let me make it 50% on the first adjustment, then you're really just better off just closing out all of your contracts, because more times than often on the first adjustment, if you make it too thick on the profit buffer, you're just going to end up getting stopped out. And if you're scaling out and you're trading multiple contracts and you get stopped out on your profit buffer, that's one thing, because remember, you already sold 70 to 90% of them. So you already made a really nice profit that you've already locked in and closed out on, and now you're just dealing with remaining runners. So if you're scaling out of a decent number of contracts because you normally trade with a lot of contracts, then it's a lot different scenario. As far as your profit buffer, you can be more liberal with it in that situation. Why? Because you've already closed out 70 to 90% of your contracts for the full profit at this particular level. So you can be a little more liberal if you're more inclined under that scenario. All right, so then once it hits this level, 1.5 level move, minimum required move for a regular trade, then we're looking at each level above, including midpoint levels and including any of the other levels here which may be in the direction and path of the trade continuing in your favor. So what that means is that YDH, since this is potentially down here going to be in our path, that this will become another waypoint that we can make a decision on closing out, adjusting a stop loss, or adjusting the runners, etc. So once it exceeds on a regular trade the 1.5 level move, then every increment above, every main level, every midpoint level, every main level, and any of these levels that happen to be in the direction of it moving in your favor become additional waypoints for decisions. So with that, at the 11:42 a.m. candle, here SPX hits the ideal minimum 2-level move on a regular trade. So a 1.5 level move is the absolute minimum required move for a regular trade. If you don't feel comfortable waiting out for a 1.5 level move and you feel more comfortable with scalps, that's fine. There's no, there's pros and cons of each way. Scalps, there's going to be more opportunities to do more trades throughout the session because you're only looking for 1-level moves in your favor. Whereas regular trades, you're looking for that to play out, and sometimes that's going to take more time to play out. Because as you can see here, this trade started back here, okay, either here if you took that trade or here. So you're basically talking in the 945-ish, 950-ish range here. And as you can see here, by the time it gets to mid R2, R3, it's about 12:45 or so, 12:30. So that's about a, that's almost 3 hours. So some people are not willing to be that patient. It's best when you're using this indicator and getting used to using this indicator. And it really doesn't matter if you're using this indicator or you're using another indicator. When you're getting used to a new indicator, whether you paid for that indicator or whether you found it for free on TradingView or you're just using some public domain indicator, that's a free source one, open source one, it's a prudent idea that you practice with that indicator for a significant period of time before you start trading with it with a real money account. Now, some people just want to jump right in. If that's their prerogative, the more prudent thing to do is to practice with it on a demo account till utilizing the indicator becomes second nature to you. And generally that is going to take most people 25 to 30 or 35 trading sessions. Some people that are already more advanced, it could take a lot less time than that. Some people that have virtually no experience, it may take a lot more sessions than that if they're not already experienced with trading options at all. So, the 25 to 35 sessions would be based on, say, an average moderate amount of experience. And then once you are satisfied with the results of using the indicator, it's become second nature. You've gone through lots of different market scenarios, lots of different wins and losses, and you are growing accustomed to placing your entries, placing your stop losses, managing your trades, taking your profit exits. If you're doing regular trades, doing your adjustments or making your decisions whether to close out or do adjustments at the required levels where you can do that, and going through the whole process repeatedly to the point that you feel comfortable with the process of doing it and you've seen good results from doing it, and you've also decided what is your best strategy for using the indicator for either, for example, taking the 9:30 a.m. opening candle trades and then also taking additional trades after that, or simply waiting and later on to take trades after the initial shakeout, whether that's the first 5 minutes or the first opening range of 15 minutes, 30 minutes, or an hour. So you can go through the process of determining what is the best process for you and using that, and also what levels what trading levels with the indicator you prefer to trade off of for bullish and bearish trades. And you will find all that out by practicing with it, and it's going to be more prudent to practice with it on a demo account. It really doesn't matter, like I said, whether it's this indicator or you could buy another indicator from another company, and it doesn't even matter if you're buying an auto signal indicator or some sort of algorithmic robotic trading system that is placing all the trades for you automatically. You would not want to just automatically jump in and start having it trade on a real money account. Even in that situation, you would want to see practice with it for like I said, 25 to 35 sessions on average. Some more advanced traders who already have a ton of experience obviously could shorten that time frame down to something a lot less than that, but anyway, that's just something you just need to keep in mind when using this indicator. All right, so we have the 11:42 a.m. R2 hit, ideal minimum 2-level move. So what they mean by ideal is this is the minimum required 1.5 level move. This is the ideal 2-level move. What we really mean by that is that in most sessions, a 2-level move, unless we happen to be in a high volatility environment, if we're in an average environment, a 2-level move is typically going to be the extent of most moves on average, with this particular symbol on average volatility. So what that means is that closing out your trade, that if you're going to stay in the trade past the 2-level move point, you really are going to be better off doing that if you're only doing that with runners, meaning you've had multiple contracts, you've taken out a lot of profit, and now you're just dealing with runners and trying to just manage 1 or 2 or 3 contracts as a runner to see how far up it may go in your favor, because on any given day it could go up 4, 5, 6, 7 levels. This particular indicator can go up to 10 levels above and 10 levels below. You're typically not going to ever use that unless we get into like a COVID situation, like during the COVID pandemic, or if we had a major world situation going on, like China invades Taiwan, or we have some incredibly good news of some kind, or for whatever reason we're entering extreme volatility. So for periods of time that we do enter extreme volatility, the V2.0 indicator does have the ability in the user control panel to turn on levels above R6 and levels below S6, so it can go all the way to R10 and S10. So that's built into here for extreme volatility if we ever see that sort of situation again. Typically in a given year, you might see that a couple of times a year, where you'll see price exceed R6 or S6. That does happen maybe a couple of times a year on average, but it's not going to happen consistently unless for weeks at a time unless we get into something like we had during the pandemic. Okay, so 38.32 is the price on the close here, so that is a $2,111.68 profit on this entry from here, or on the other entry, a $2,041.68 profit. The 67.85 out of the money call was $29.40, so that's $1,500 profit. The furthest out of the money, $25.20, $1,320 profit. At 12.26, the YDH level is hit. So as I talked about earlier, when these other levels here happen to be in the pathway of your trade, once it exceeds the level on a regular trade of the 1.5 minimum required move, if any of these levels happen to be in the direction, so if we were talking about a bearish trade, then it could have been one of these other levels, but in this case YDH is in the pathway, and so this is another decision point here, and the 67.75 at the money on this entry here is 47.28 on this candle close, 2,738 profit. On this other scenario here, it's only 2,648 profit. The 67.85 out of the money call, 37.20, so that's $2,270 profit per option. The furthest out of the money, 67.90, $32.60, so that is $2,060 profit. And finally, here at 12:34 p.m., it hits on this candle here the mid R2, R3, which is kind of marked out a little bit here by the price action, but that is 68.25.87. So in this candle here, it hits that. So that's a 2.5 level move on a regular trade. The first scenario here, 52.30 is the price on this candle close. That's $3,220 profit per option. The 67.75 at the money from this scenario, you had slightly less profit, $3,150, and the 67.85 out of the money is $42.30, so that's $2,780 profit, and the 67.90 furthest out of the money is $37.70, $2,570 profit. Alright, so as you can see here, this was kind of the end of the road. All we did was basically travel sideways for most of the rest of the day until about 3:30. And this brings up another part of the strategy, and that is the lotto plays. So we don't bring up the lotto plays in all of our videos. We brought them up in maybe about 15 or 20% of them. But we're going to go over that again today. So it's not that the lotto plays were only relevant in the 15 or 20% of the videos. They're relevant every single session. They're just dependent on a couple of things. First of all, the lotto window starts at 2 p.m. and runs to the 4 p.m. close. Generally, you want to try to enter any lotto plays you're considering before 3:40 to 3:45 p.m. hits. That is generally. That doesn't mean that there might be an opportunity after 3:45, but remember, SPX closes at 4. So even though lotto plays are high risk, high reward, and you should view lotto plays as just like a lotto ticket, you are going to expect that whatever money that you put into a lotto play is going to be the total risk. Now you can use stop losses with lotto plays if you wish. Generally, at that time you're going to have rapid price deterioration. So there's two schools of thought on lotto plays. One is just to selectively use ones that are priced effectively enough to where you're minimizing your risk just with the cost of the option. Because the rapid price action that can occur, especially in the last half hour of the session, you may get whipsawed around quite a bit. And if you have what's considered a regular stop loss, more often than not, you're just going to get stopped out before it makes a move that would have been in your favor. So the other school of thought is just on lotto plays, just consider whatever amount of money you're putting towards lotto plays to be the total risk that you have to be willing to lose, and not use a stop loss. So you can use a stop loss, but just be aware that because price can really whipsaw around, especially in the last half hour, that you are probably going to get stopped at a lot of times before you would have made a big profit, and thus you're just going to get very aggravated. So with that, there is a rule with the strategy that you only use up to 10% of your session net profits. That means the current session. So if you didn't make any money in this session, then you have no profits to take 10% of to do any lotto plays, and you shouldn't be doing any lotto plays because you have no funds to do them with. You should self-fund your lotto plays from your current session profits only. And with that, you only use up to 10% of your session profits to put towards any lotto plays that you're considering. So for example, let's say that you took this as the first trade. You had no loss here on the 9:30 because you didn't take the 9:30 a.m. candle trade, and you did this first trade here. And let's say that you got out after the R2 hit, and you have a $2,111 profit on the day per contract. Well, if you only traded one contract, 10% of that is $210. So that you have up to $210 for lotto plays. If you traded 10 contracts and you have a $21,000 profit, then you have up to $2,100 for lotto plays. Now that doesn't mean that you need to use all of the 10% for lotto plays. It just means you have up to that amount for any lotto plays that you consider. And the reason for that is because there is a very good chance that you will lose all your money on lotto plays. However, if they do pay off, they often pay off on single directional calls or put plays, 4x to 10x or more. And there have been many sessions where lotto plays have paid off 20x to 50x. There's actually been some sessions that they've almost reached 100x, when for some reason there's been some sort of news that came out at the end of the day, or something else happened, and you got a monster move in one direction at the end of the day. And sometimes you will have days like that, but there will also be lots of days where the lotto plays will be zero and you will lose all your money. So that is why, if you're going to consider doing any lotto plays, that you only consider using up to 10% of your current session net profits to do so. That way, if you do not make a good play, it does go to zero. Or let's say if you did use a stop loss and you lost 50% or more, depending on what stop loss you want to use, then you still have 90% or more of your session profits intact that you can go home with. Okay. Typically, lotto options that you're looking for, as far as single directional calls or puts are going to be ones that are at range from 30 to 50 cents to approximately $3 or so for buying single directional plays. That means you're either buying calls or buying puts. That you are looking for a single directional play only. Now, you do have non-directional plays that you can do, but they will not have as high of a return potential as single directional plays. So you can take the guesswork out and do a non-directional play as opposed to picking a direction, and you do that by either using strangles, which is buying an out-of-the-money call plus an out-of-the-money put for a non-directional, or straddles, which is buying an at-the-money call and put at the same strike price. Straddles are the most expensive lotto play. So for example, just to give you an idea, the straddles that were in the last couple of candles today, say the last 5 or 10 minutes, we're going for $4 to $5. So that's buying an at the money or nearest at the money to where price action is at that time. So let's say it was right here, 68.08. That would be the 68.10. So you'd be buying a 68.10 call and a 68.10 put. And the price for that today in the last 5 to 10 minutes would have been around between $4 and $5. The further back in time you go, the more expensive they become, the at-the-money straddles. So back here, it might be more like $9 or $10 back in this area here, as opposed to down here when we're running out of time and the time deterioration is rapidly deteriorating those and they get down. If we're in a lower volatility day, then this area here might have been more like a $6, $7, or $8 range in a lower volatility setting, when the IV is lower than it was today. So your straddles are going to be a non-directional play at the money, and those are going to be the most expensive, and the only way you profit from those is it's got to move and move quickly, because you're burning up time decay on both sides. So you paid the most because you're buying at the money. You're buying an at the money call and put, and it takes the directional side away. You can profit from it. You don't have to pick a direction, but it's going to cost you more to have that luxury. And on the other side of the coin, it's also going to rapidly deteriorate the most should price not move at all. In this case, we saw a decent move here from, this is basically the last 20 minutes here, the last 10 candles, where we're going from 68.20 all the way down to almost 67.95, 25-point move. So if you're buying a straddle back here for, say, 6, 7, 8, then down here it's 4 or 5, that's still a pretty good profit. However, if price was just moving sideways, never going anywhere, just kind of bouncing back and forth, then that $6, $7, $8 you paid back here is going to start rapidly deteriorating down to 5, 4, 3, 2, 1, and eventually 0 if it just ends up being closing at or near the price strike that you picked. Whereas strangles, you're doing an out of the money call and an out of the money put. So these will be less expensive than straddles. However, price needs to move more because they're out of the money. So this is still a non-directional play. You're buying an out of the money call and an out of the money put, ideally equal distance away from current price when you're making when you're considering that strangle. So if you're buying one that's 5 points away on the upside, or 10 points away on the upside, and then 10 points away on the downside, or 5 points away on the upside and 5 points away on the downside. Whereas straddles, it's the same strike on both sides. So both of these plays are going to have not as high of a return potential as single directional plays, meaning you're just either buying puts for a move down, or you're buying calls for a move up. And on certain days, you'll see those where it really just depends on how out of the money your calls or puts are on the single directional plays as to how cheap they are, whether they're going to be 30 to 50 cents or somewhere in approximately, say, the $3 to $3.50 range. All right, so we are planning on making a specific lotto window video. That will be a longer, more detailed video, which we will take a couple different sessions, and we will go into looking at the different strategies and also going through different pricing scenarios and showing the thinkorswim option charts on the various plays, and then also go into at the end of the day lotto strategies as far as picking a bullish or bearish play. We're not going to do that today, but I did want to explain how the lotto window works and that you are self-funding it with up to 10% of your session profits. There's no obligation to do lottos. It's just that if you already have built up a nice profit earlier on in the session, that is an option for the end of the day that you can keep in your back pocket, that you could take up to 10% of your profits and employ that if you saw that price action, as far as the context of the session, was dictating that there are better odds for a decent move at the end of the day. There's not going to be one every day, so lotto plays are certainly not something that you want to try to do every single day, although even if you did, you're only taking 10% of your session profits each day to do that, so you can still retain 90% of your session profits. Okay, so that's going to wrap up this video, and I hope you have enjoyed this video. If you did, please like the video as it helps us with our YouTube algorithm. If you'd like to be notified of new videos when they are on this channel, then you can subscribe to the channel and you'll automatically be notified when we come up with videos. We try to do a variety of videos, both on sessions like today that will be a lot longer videos, and then we will do shorter videos on specific topics with this particular indicator. Also, as we mentioned at the beginning of this video in the preview, if you are interested in purchasing this indicator, you can send us an email at daytradinggps@gmail.com, and in return for your taking the time to watch this video today, you can request a discount promo code for the SPX Daily Key Levels indicator that will give you a substantial discount off of the regular price. All of our indicators are sold on a one payment for lifetime access basis, and that means that when any new updates to the indicator come out in the future, or new versions of the indicator come out in the future with any enhanced versions, this is the v.2.0 version. There was an original version of this indicator, but this one was just released a few weeks ago. We also plan on coming out with another version with more enhancements and more features very soon, which will be the v.3.0 version. However, at that time the price will be going up, but if you already have the indicator, or if you purchase the indicator before that happens, then you will be able to get that update v.3.0 at no additional charge, and then obviously any other updates in the future, as you will have lifetime access. The main point is that the price will be going up once that v.3.0 0 version is released. So if you want to get the indicator now at the reduced regular price and also apply the discount promo code, then you will also get the future versions at no additional charge, whereas new subscribers at that time will have to pay the much higher price. Alright, well, thank you again for watching this video, and we appreciate you supporting our channel, and we wish you much prosperity in all your future trading.